There are hundreds of patterns in trading, but if you are a beginner, you've probably run into the same problem. The formation looks nice, everything seems to be lined up, still the market goes the other way. Why is that? Because 90% of patterns are visual illusions with no logic behind them. The ones that work aren't the ones that look like in the textbook, but the ones backed by the market participant behavior. Today, I'll show you 5 reversal patterns that actually make sense. These models help you spot the moment when the crowd still believes the old direction while the market is already getting ready to move the other way. And once you get the principle, you'll stop hunting for the perfect formation. You'll start understanding the market from the inside. But before we jump into practice, I want you to have access to a resource where I've put together the most important stuff on the topic. It's my open resource where I publish working setups, real examples of formations that played out, my subscribers' results, and detailed analysis schemes. In the pinned posts, you'll find indicator setup guides, risk management methods, and adapted martingale manuals, so you can build your setups consciously, not by guessing. It's not a course, it's not an ad, just a knowledge base where I keep updating. Follow the link in the description, download what you need, and don't forget to activate the promo code. It unlocks extra sections and fresh updates. Now, let's get to the point. The first pattern is called double top. It is the simplest, at the same time one of the most reliable models, especially on higher time frames. The idea behind it is that the market tests the same level twice and still can't break through it. Each new push gets up weaker and the pullbacks get deeper. Psychologically, this is when buyers lose the initiative. After the second touch of the level and the subsequent break of the neckline, the zone where the market tried to hold a reversal starts. The main rule: don't rush. The pattern is considered complete only when a candle closes below the neckline. If you see price come back to that level and it turns into resistance, that confirms the reversal. The second pattern is double bottom, the exact opposite of the previous one, but the logic remains the same. The market tests an area twice where sellers can no longer push price down. Each bounce up gets longer and the downward impulses get shorter. When price breaks the neckline upward and holds above it, the reversal phase begins. The main thing to remember: don't try to catch the bottom. Wait for the breakout confirmation. You see, most mistakes happen because traders try to enter early, assuming a reversal instead of waiting for confirmation. The third pattern is called head and shoulders. This one is more complex but incredibly strong, and it doesn't form in a single session. It reflects a real shift in balance between buyers and sellers. The left shoulder is a first impulse and an attempt to keep pushing high. Head is the peak after which the market shows weakness for the first time, and the right shoulder is the last attempt to get back into the trend, but it's shorter and weaker. After the neckline breaks, price moves the other way. The market often does a retest of that level, and that's the best entry moment. On down moves, the pattern flips, and that's the inverse head and shoulders. It works the same way, just to the upside. The fourth pattern is called engulfing. This model is especially useful on lower time frames when you need to quickly spot a reversal of an impulse. It shows up when one candle fully engulfs the previous one, meaning its body covers the prior candle's range. For example, in an up move, a strong bearish candle appears that wipes out the entire previous structure. That tells you a large volume stepped in against the old move. The key is not the candle color, but where it formed. An engulfing in the middle of a range, that's just noise. But if it appears at extremes or at the trend boundaries, that's a strong reversal sign. And finally, the fifth pattern, the hammer and its opposite, the hanging man. These are single candles, but their strength is in the context. When after a prolonged decline, you get a candle with a long lower wick and a small body, the market is showing sellers can't keep the pressure anymore. Price pushed down, but quickly snapped back up, which means big players started buying up volume. The upper version, the hanging man, works the other way. After a rise, a candle with a long upper wick appears, signaling buyers are running out of steam. It's important to wait for a confirming candle to make sure that the market really started to turn. If you want to dive deeper into these formations and many other aspects of the market, I'm inviting you to my trading community. There we break down each pattern in real time on live charts, explaining why and where it plays out. It's not just a show and forget format. It's daily practice where participants learn to read the market consciously. To get in, just message me directly. I handpick members to keep the vibrant level. Access is open for now, but the group is limited. Contact in the description under the video. If you're into the idea of systematic trading without guesswork and chaos, subscribe to the channel. In the next videos, I'll cover how to combine these patterns with indicators and why seeing structure matters more than just hunting for any random entry point. See you in the next breakdown, and may every analysis you do be informed.